Hey everyone, this is Robert with Gold Silver Pros. Hope you guys are doing well. It is January 17th, 2019, and I'm going to be starting a new weekly series for the website. It's going to be called the Weekly Market Wrap, and I'm going to be focusing on what I see happening in the markets. Hope you guys find this informative. So I wanted to jump in for the very first edition of the Weekly Market Wrap into a long view of the stock markets, and I've got it graphed out here since 2014. The end of 2014, and I've got the Dow Jones, the S&P 500, and the NASDAQ. The NASDAQ is the purple line, the S&P is the light blue line, and the dark blue line is the Dow Jones. And I just want you guys to look at something for a moment and see if anything really sticks out to you. And what I see is I see this extremely strict correlation between the three markets. And they're really supposed to be measuring different parts of the stock markets. The NASDAQ really is a lot of the tech-focused companies or have some sort of tech component to them, typically. And so that sector, you can see, rises a little bit more than the others at times because tech has been a supercharged sector in the last bull market for the last 7, 8, 9 years. But then you also have the S&P 500, which is the 500 largest companies, and then you have the Dow Jones Industrials, which is the 30 largest industrial companies. So they're supposed to all be measuring different pieces of the economy. And one company can fit into both the S&P 500 and the NASDAQ, for example, but the S&P 500 may not be exactly the same as the NASDAQ. The NASDAQ has a smaller focus, and the Dow Jones Industrial 30 is really just 30 companies, not 500. So you would think that you would see different things going on, but they're almost exactly the same. Look at this. Every peak and every valley is almost identical. You really don't see these markets crossing each other that often. Sometimes they trade identical like you see here, but you don't really see one falling below the other, and they have almost identical moves. See, when you have a peak here, they all peak. You have a trough, you have a peak, you have a trough, you have a peak, you have a trough, you have a peak, you have a trough. It's all the same. And it's just uncanny how much these markets, these indexes, which are supposed to be managing different aspects of the stock market, are all the same. And the point to this discussion is I really think they're all driven by the same thing. And it's basically two things. It's once the easy money policies of the Fed, where there's been so much incentive with the low interest rates for all the U.S. corporations to take on all this debt and use that debt, that free money essentially, to go on spending sprees. In a lot of cases, they'll either grow their business or they'll do stock buybacks or they'll do any number of things. But they've taken on a ton of debt, and their growth has not necessarily come from their overall production. And that's why you see really sky-high price-to-earnings ratios, meaning the price of the stock is a lot higher than the earnings that you get from owning that stock, and they're so far past historical valuations. And I've talked about this a little bit before. And what that means is the stock market is basically overvalued. But what's more important than that is that everybody has benefited from this easy money campaign to where it's almost like they could do no wrong, because you would have some dips, but then it just goes straight back up and straight back up and straight back up. And I'm going to see if we can get the chart to go out to max. In fact, we may have to squeeze this down a little bit. Let's go to since the last market crash of 2008, if I can get this working. There we go. So you see the crash of 2008 all the way forward to present day, and it's been nothing but up. And of course you can see the tech stocks as represented by the NASDAQ going up more than the others, the more traditional stocks. And it's because of that easy money. If we were to graph out how much money the Fed is injecting in the system, how much debt that these companies have taken on, there is a direct correlation to the stock market. The second piece of the puzzle really has to do with passive investing. Passive investing is like your 401k or your 403b or any sort of managed fund or an index fund or an ETF, an exchange traded fund, where a lot of money goes in there, and the indexes that those funds are tracking or the people that are managing those funds stick that money in the same place. It's in the same stocks. So for example, if you look at your 401k and you have a large cap index and a small cap index, and then you have a blended index and you have a foreign investment index, if you really look at it, by the time that you select your allocations, you may be investing in the same overall section of the stock market or the same overall stocks multiple times upon each other. If you take two growth indexes, for example, and you want to go heavy growth, guess what? It's going to be investing in the overall same sectors and the overall same companies, or at least group of companies. And so what happens is you have a lot of money going into those companies, pumping it up, without necessarily reflecting the actual operations of that company. And yes, individual stocks will go up and down as they do better or worse, because fund managers can take stocks out and put stocks into these funds. They can rotate the investment. But when you have so much money going into the stock market in general, it tends to lift the entire thing up above what it's actually should be priced at based upon the earnings. And that's really a big concern. And you notice where there's no deviation, no matter where you go in the stock market, they're all doing the same thing. Now, one individual company may not follow this path, but in aggregate, they're all following this path. So whether you're looking just at the industrials in the blue, the broad market, the top 500 companies in light blue, or the tech sector, it's all the same. There's no deviation. And again, it really shouldn't be that way. Things tend to be very cyclical, whether it be a sector or a company or a specific market. And these things should be crossing each other. At points in times, the tech stocks will do better. Sometimes they'll do worse. Sometimes the industrials might do better. Sometimes they might do worse. Sometimes the broad market, when everything's considered, might do, should probably be in between the two most of the time. But they're all moving in lockstep. And that's a sign that the market's really not driven by fundamentals. One is driven by sentiment, is driven by all the money printing and the easy debt that has driven all these corporations up. And then in return, all the people that own these stocks, studies show that people that own stock typically own their company a lot more, and people that own stock tend to be workers of companies. And so all that money is just funneled back into the market that's supporting all these companies. At some point in time, that has to give. At some point in time, we have to come back to reality where valuations of these companies are right and fair and historically accurate, about 15 times earning, 12 to 15 times earnings, which should be their price level. And that eventually will happen. And anybody who looks at a chart like this over time and says, yeah, that's a normal market, it's really, really not. And it's really been this money printing that we've had, and the fact that we have these mutual funds and index funds, and people really don't decide their own investments anymore. They just kind of shove money into something and say, oh, I'm being matched on my 401k. Well, you're being matched because companies have got this free money from the Fed, right? That's why they're throwing matches at you. And so they're all being put into the same stocks and the same pools of investments over and over, and that's reflected in this market. And it really is not a true market. And I just shudder to think what's going to happen when that true market really returns, when the easy money is over, because we're in QT right now, quantitative tightening for the Fed, and we're getting rising interest rates on corporate debt, and corporates have more debt they've ever had in history. So eventually something's got to give. All that growth has got to stop. You can't keep taking on debt, because eventually you'll have money to pay off that interest rate or to pay off the debt itself when the principal becomes due. And the Fed's already said we're not going to print as much money or make credit as easy. So eventually this all has to stop, and I just wonder where the landing point is going to be. And I wonder if, this sort of easy money policy in this ever growing stock market, ever increasing stock market is going to end, and what that's going to look like. Well, I wanted to show you guys something interesting. This is something I've covered on Seeking Alpha before in an article. And if you looked at my article on Gold Silver Pros entitled Analyzing Market Risk with a 40-Year Market Veteran, when I talked to Lynette Zhang, this is something we talked about. We talked about insider buying and insider selling. Insiders are people that basically run companies. They're the directorship and the people that are inside the company that are at the top that really know what's going on. They have the most information about their companies. And as you can see, they've been selling more than buying for a long time. In fact, one of the charts I had in an article I wrote on Seeking Alpha shows that since the financial crash of 2008-2009 timeframe, so when the general market's going up and regular people are putting their money into the stock markets, the insiders have been selling net since then. In fact, not only have they been selling, they've been selling at like a 3-to-1 ratio. So the insiders don't have the same amount of confidence, I think, that the money managers do, and people putting money into the stock market through their 401ks or pension funds or whatever the case may be have. And I think the regular average everyday person may be buying more into the stock market than the people that run these companies and know what the companies should be valued at are doing, which are selling their stock. They're getting out of stock and they're going into other things. And so this is a really telling graph right here showing that look at how much more selling volume there is than buying, and it's been steady since the financial crash. So just may be a good time to reevaluate your strategy. This has been going up. We haven't had a crash. It looks funny because the markets do the same thing. They move up and down in lockstep. If we just go to the 3-month, look at the 3-month chart since November. Exactly the same. Every single day, everything the same. It's like it's a planned market. And it's acting like a planned market because you have all this money continually going into it, investing in all the same things over and over and over and over and over. So everything, no matter how you section it off and what index you use, it tends to move in lockstep. And that's just really a dangerous situation because we're not getting the signals to know whether the market is healthy or not, or whether one sector is better than the other. And we need those signals to understand where the market's at if we're going to be putting our money into it. One other thing that I wanted to show you guys, I'm going to blow this chart up a little bit. This is off of Zero Hedge. This is talking about monthly CLO activities. This is collateralized loan obligations. The CLOs buy more of the sort of junk debt, or what they call the leveraged loans, than anybody else. And that traffic fell off precipitously in December. And the analyst here for this story is basically saying this is typical late cycle behavior. And what he means by that is these people that typically buy this higher risk debt, these leveraged loan obligations, stop buying them when they feel like there's a point where they're not going to get their money back. They're not going to get the return. And that's an indication we're at the end of the cycle, meaning we're at the end of this big bull cycle that you see. Let's go back to like a 5-year chart and let's kind of stretch it out if we can. Well, we'll just stay there. This bull cycle, this increase in stock prices, increase in company valuations, when you see these people buying less of this debt, this leveraged debt, the sort of junk debt that results from having too much debt in the system and having it become higher and higher risk, this is an indication we're at the end of the bull market. So that's another indication that you may want to consider that the stock market is not going to quite do what we think it may do going forward. We're probably at the end of the bull market, and it's time to shift out of some of these riskier assets, such as the bonds and the junk debt represented in this chart, and also the stock market, which you see represented here, because our sell sign is the insiders. The insiders are selling out of the stock market. The CLOs are buying less of this leveraged debt obligation, or this sort of junk debt or high risk debt. Those are signs that the smart money is getting out of the way for when the crash happens. Here's a Fed study of the search of the Phillips Curve, and Mish basically has some comments on it, and I wanted to explain what the Phillips Curve is. It's an economic model developed by A.W. Phillips, which purports that inflation and unemployment have a stable and inverse relationship, meaning that when inflation is going up, or the price of goods are going up, that unemployment is going down, and when the price of goods are going down, unemployment is going up. And that's not really the case. That only happens about 50% of the time, but there's no direct correlation. As you look at this graph on the chart, it's about a 50-50 deal. Why is that important? Well, the Phillips curve is one of the major bases for how the Fed allocates interest rate policy. In other words, the money spigot. The Phillips curve drives a lot of decision making around how easy the credit is, and the lower interest rates that allows it easy credit, which allows this increase in the overall amount of money in the system. But this model doesn't actually work, and so the assumptions made by the Fed, at least a large part of their assumptions, don't really play out in real life. So the Fed is making monetary policy decisions based on models that don't work in real life, no matter how much people want them to work. And so that's going to have unintended consequences, because we've had easy money for too long, and the policies that is supposed to enforce, don't seem to, that relationship doesn't seem to hold true. So we expect that the Fed has probably blown up the system more than it needs to be, and we don't even know, or I don't think they know at what point they actually need to stop. And that's why you're seeing in the news a lot lately around Jerome Powell saying, well, we think we're going to ease, but we're not really sure. We may tighten, and he's been kind of waffling back and forth because one of his major signals is not really telling him what to do. It's because the signal's flawed in the first place. Another thing I wanted to talk to you about was what's happened in Russia. There was a story several months ago about Russia dumping U.S. debt, the treasuries that it held, and it dumped almost all of them, if not all of them, and it exchanged them for other things, whether it be oil or gold or whatever else in the market. Well, now Russia is dumping $100 billion of its dollar reserves and exchanging into the yuan, the yen, and the euro. And so they're basically getting out of not only the U.S. debt, but the dollar. And what does that mean? It basically means they see what everybody else sees. They see that we're at the end of the bull market. They see all the insider selling. They see people stop buying risky U.S. debt. They see the fact that the Fed doesn't really know what to do, and it's sort of at the end of its rope with its policy, and they're saying, we've already gotten out of the U.S. debt, now we're going to dump the dollar, because they don't think long-term the dollar has value. That's why they're going into these other alternative currencies, the Chinese Yuan, the Japanese Yen, and the Euro, because they think it's safer than the U.S. dollar. That's a big sign that the risk has gotten too heavy for Russia, that they're not going to hold that $100 billion of U.S. currency. That's yet another big sign that people are starting to get out of the dollar and go into alternative currencies, but also gold, because Russia's been buying tons of gold lately, and that's something that I've also covered on my channel as well. Look out for articles in my free markets section where I talk about that. So I just wanted to talk about what I was seeing in the markets this week. Overall, if we just look at a 5-day chart, the markets overall went up, but I think this may be sort of the last part of that bull market correction, or that last sort of gasp of the market. I expect it longer term to fall. I mean, it could still go up 2, 3, 4, 5%. I don't think we're going to see the highs that we saw last year or before 2018, when it hit a high and then it started coming down in 2018. I don't think we're going to hit that previous high. I don't think we're going to go 30,000 Dow or anything like that. I think it's definitely going to come down, and I think the signs are there. So this is sort of a false positive, but I would be wary of that, because there's a lot of other data that suggests that the smart money is getting out of the system. So this may not be a good time for you to shove more money into these risk assets. This debt, as depicted here, and the stocks that the insiders are selling, you may want to follow that smart money and sort of get out of some of these, or reallocate maybe into something else. Of course, I would say gold and silver. It's up to you. I'm not a financial advisor, but just be wary of that risk. And some of this news really should help you, educate you on what's going on, what the smart money's doing, what other sovereign nations are doing with regard to U.S. treasuries and U.S. dollars. So you can kind of see the roadmap for what's going on, and you can sort of plan accordingly. Okay, I'm going to go ahead and get this wrapped up. This is the very first weekly market wrap. I'll do this every week, either Thursday or Friday. I'm doing it Thursday this week because I'll be traveling to Vancouver. So stay tuned for that. I'm going to go to the Vancouver Resource Investment Conference. I'm going to go up and speak to a lot of the company management that are doing the mining, whether it be gold, silver, or even some of the others like uranium and copper and all of that stuff. And I'll be talking to some industry experts as well to see what's going on. I have a feeling that I'm going to find that there's more money coming into the sector. That's what we started to see last year when I went to the Vancouver Resource Investment Conference last January. I expect to see more of the same this year. I'll bring you guys some insights from that when I come back. I'll probably write a story about it. And for my subscribers, especially for my subscribers, I have planned some really good insider information that I'm going to attach to February's member monthly digest and the broadcast, so stay tuned for that. This has been Rob with Gold Silver Pros. Thank you very much, and have a very good weekend.
This has been a Gold Silver Pros production. Please subscribe to us on YouTube and sign up for our newsletter on goldsilverpros.com.